So good to be at this event actually, and in particular this group. I've got very fond memories of my high school economics teachers, and just the enthusiasm that they showed was just such an integral part of my kind of study and career pathways. So yeah, I just thought it'd be good to kind of acknowledge that and the role that you play in so many students, kind of present but also in the past as well. So as Jackie said, my name is Tim Atkin. And I work in the foreign exchange dealing and analysis team. I've been at the Reserve Bank for over 10 years now, and over that time I've worked across a range of areas, including, as Jackie mentioned, in the public education program. And that's actually when this event was first set up, so it's great to see it still running strong today and great to see so many faces here too. More recently, I've been managing the team that looks after the Australian dollar, or the Aussie dollar as we like to call it, as well as Australia's external position. So those two things do link, and it's quite nice to see how the developments on one side interact with the other. And so this afternoon, or this morning actually, still I think, yes, I want to take you through some developments in Australia's trade and financial flows. Again, this is an area that I vividly remember from high school. It's probably one of the more difficult areas, but also rewarding once you worked out how these different areas link together. And don't worry, I'm still working out how all the different aspects of this link together when we get a quarterly release of the balance of payments too. So yeah, I hope the material today will help add to your understanding of what's going on in the Australian economy. But also I hope that it provides some relevant examples that you can take back to your classroom as well. And it's so good having Timmy here as well to provide that additional sort of perspective on things. All right, so to kick us off, what I want to do is actually take a look at a longer run view of the balance of payments, just to provide a bit of historical context and introduce a few key concepts. So this chart here is a real classic. It shows the two sides of the balance of payments. And I think the main point to take away from this is that really big shift in the current account, and also to a current account surplus and to a financial account deficit over recent years. And especially because this might not actually be all included in all the textbooks. It's definitely a shift that we've seen very rapidly and very different to our history. And so if we move our attention to the right of the graph, you can see in the current account, in that top panel there, that it's narrowed since around 2016, reaching around 4% of GDP. And this has also been mirrored in a financial account deficit on the bottom panel there. And it's these developments that I really want to focus on today. But before we do this, I just want to cover off on some of the historical perspective. And so we're in a very different position today to what we're used to, as Jackie mentioned. We're used to a current account deficit. And so we're used to surpluses on the financial account, and we're used to saying that Australia was a net importer of capital. And over the past 3 decades, the current account deficit has averaged around 4% of GDP. And while it's normally thought about as the sum of the trade balance and net income balance, it is also equal to the savings and investment gap. And it's this concept that's really helpful for thinking about how developments in the domestic economy are related to changes in the external accounts. And so using this approach, we can think about the deficit, the historical deficit, reflecting investment in Australia being greater than savings. And so funding for these investment projects was sourced from overseas and resulted in net capital inflows, which were reflected as a financial account surplus here. And so these inflows essentially topped up domestic savings, and Australia borrowed from the rest of the world. And that was to fund those investment opportunities. And so it's with this historical context, thinking about the large shift and thinking about some of those concepts around savings and investment, that I think we're well equipped to move on through these recent developments. And to help guide us through the presentation today, I just want to take a quick moment for a quick refresher on what the balance of payments are, take a look at the savings and investment trends before talking about the current account perspective. From there, I'll look at the financial account and also how that's flowed through to the international investment position. So we're covering a lot, but I hope to take you through that all. All right, so jumping into a quick refresher now. And without getting too stuck into the weeds, the balance of payments summarises a wide range of economic transactions between Australia and the rest of the world. These transactions cover exports and imports, as well as financial assets, so things like equities and bonds. Transactions are classified into two broad accounts. There's the current account, and there's the capital and financial account, those lines that we saw on the previous graph there. And these are often referred to as the two sides of the balance of payments, with the idea being that they balance out at the end of the day. And so the current account, that captures exports and imports under the trade balance, and the net income balance is looking at the income flows related to our international investment position. So examples here include dividend income we receive on foreign shares that are owned by Australians, or interest payments on Australia's foreign debt. And so if we look at the capital and financial account, and mainly the financial account here because that's the bigger of the two accounts, much larger, it captures changes in the ownership of financial assets and liabilities. And so it's typically broken down by different investment types, or we like to think about it through different investment types: direct investment and portfolio investment. So again, a couple of examples. If an international business buys a stake in an Australian company, this would be included here. Or if an Australian buys US shares, that would also be included here. And so transactions in this account are often referred to as the net flow of capital from Australian investment abroad and foreign investment into Australia. And finally, the international investment position is the net stock of assets and liabilities that's built up or is accumulated from these net capital flows over time, as well as some valuation effects on those particular assets and liabilities. All right, so quick refresher out of the way. What I want to do now is look at some of the key trends from the perspective of Australia's savings and investment gap. And this will hopefully help us bring us along on the journey to understanding developments in the current account too. So this chart here shows a long-run picture of savings and investment in the Australian economy. And on the bottom, you can see the current account balance there. So just to reiterate the relationships, well, the current account is made up of the trade balance and net income balance. This graph is really helpful for highlighting that it's also equal to the savings and investment gap. And so on the top part of the chart, you can see that investment was greater than savings for a big chunk of Australia's history. And this corresponds with the long history of deficits. So it wasn't until investment declined off the back of the mining boom, you can see that blue line sloping down a little bit there, and savings increased from around 2016 that the current account started to narrow or move towards that zero line. And as savings started to exceed investment just before the pandemic, the current account moved into surplus. And so no longer did we need to source capital from overseas, but instead we moved to a world where savings were greater than investment. Now, more recently, some of this is unwound as savings have declined a little and as investment has picked up a bit after the pandemic. But the key point is that we're still in a world where Australia's external accounts look very different to their history. And so to help understand this a little bit more, I want to go through some of these savings and investment trends in some detail. All right, so taking an international perspective first, this graph shows those savings and investment lines against the experience of other advanced economies. I think the main point for me here is it helps to highlight that Australia's experience of current account deficits was mostly because investment here was higher relative to other economies. And we were able to import capital from foreigners to fund this. And you can see this on the right-hand side of the graph in the investment panel there, where that red line really jumps up during the mid-2000s. And so this was at the same time that investment in other advanced economies really struggled to recover from the effects of the financial crisis in 2008. And as I look to explain this, I think former Deputy Governor Guy Debelle covered this quite well in a speech from 2019. He said, "Savings in Australia were not particularly low, but we sourced capital from the rest of the world because the share of investment in the Australian economy was higher than in many other advanced economies, and foreigners were attracted by the investment returns on offer." And so I think this raises or begs the question as to why was the Australian experience so different? breaking it down a little bit more and looking at where investment has come from, I think the big story that you can see here is the mining boom. So that bottom line there shows mining investment peaked at a bit below 10% of GDP as Australian companies invested a huge amount in additional mines, ports and rail to boost the amount that they could export to China. And this was in response to that expected global demand and also record high commodity prices at the time. From here though, you can also see that mining investment fell from its peak as this phase of the boom came to the end. And non-mining investment as a share of GDP also declined, reaching its lowest levels in the past 2 decades as the effects of the pandemic hit in 2020. So following the pandemic though, investment has been supported by a pipeline of projects as firms do look to expand their capacity and as supply constraints have eased. But overall, with this lower share of investment and as savings have increased, there's no longer a gap between investments and savings that needs to be funded by foreign capital inflows. And this is one of the key trends behind the shift in the current account. So on the other side of this, savings has increased to its highest levels in at least 2 decades. In the years leading up to the pandemic, national income was boosted by export earnings as additional production from the mining boom came online and as commodity prices increased to record highs. And part of this was saved. There was also a jump in savings for households and businesses during the pandemic, which you can see in those blue lines there. Households saved more money with less opportunities to spend it. And there was also a boost to incomes from government policies too. Since then though, you can see that savings have declined a bit as a share of GDP, that top line, the total savings line there. But this has been particularly stark for households as they've faced the effects of higher prices, higher interest costs and taxes on their incomes. But despite this, national savings remain higher than investment, and Australia has exported these excess savings through net capital outflows, which has resulted in a financial account deficit. And this is the mirror of those current account surpluses that we've seen. So hopefully these trends in the domestic economy provide a bit of a link to the developments that we'll now look at in the balance of payments. So moving on to the current account perspective, and hopefully something that's a bit more familiar when we're thinking about trade. I know it is for me, definitely. This graph here shows the current account in the top panel with its components, the trade balance and the net income balance below. And now your students are probably going to be asked at some point about what the key drivers of the shift might be. And I think this graph is really useful for highlighting that. It helps to highlight that the key driver of the current account surplus over recent years has been the trade balance, that orange line really moving higher there. And the main story here has been a huge rise in the value of resource exports. And again, this links back to the mining boom story and also reflects the big rise in commodity prices that we've seen over the past 5 or so years as well. So again, diving another level deeper and looking at resource exports to get an idea of how that's played out. All that investment led to additional capacity, which flowed through to an increase in the volume of bulk commodity exports, such as iron ore, coal and LNG, which you can see on the left-hand graph there. And so over the past 15 years, coal and iron ore exports have increased from around 50 million tonnes to 100 and 200 million tonnes respectively. And LNG exports from around 3 million tonnes to almost 20 million tonnes. And so one thing you'll notice about this graph is that the rate of expansion in the volume of these exports has actually slowed. And the increase in volumes has flattened off a little. But big increases in the prices of these bulk commodity exports have still supported the value of these exports. And you can see this on the chart on the right there. The chart on the right shows the RBA's index of commodity prices and Australia's terms of trade. And so since 2016, commodity prices have risen significantly again. And if you think back over the past few years, there was a particularly big boost in 2021 as the world emerged from COVID and global growth prospects improved. And there was another big boost in 2022 following the invasion of Ukraine and other disruptions to global supply chains. And so as a result of this, commodity prices and Australia's terms of trade reached new record highs last year. And from the graph there, you can see that they even surpassed the levels that we saw during the mining boom period. And so this has been a key driver of the sustained increase in the trade balance and the shift to current account surplus. But the increase in the trade balance hasn't just been a story about resources. Our second largest export category is services exports, and you can see that in the top right-hand panel there. And you can see that there was quite strong growth here, particularly in education and tourism exports over the decade leading into the pandemic. However, there's quite a sharp drop-off as international border closures and the effects of COVID meant a sharp decline in these exports. More recently, though, as travel restrictions have been removed, education and tourism activities have rebounded and services exports have increased significantly again, moving back towards those pre-pandemic levels. Another thing to note here is the bottom right panel, rural exports. They've also increased strongly and are at historically high levels. And this reflects favourable weather conditions and record crops in Australia over recent years, combined with elevated prices as dry conditions in other parts of the world and the war in Ukraine have affected global supply. And so with that breakdown of the trade balance and showing that it has been a key driver of the current account, what I want to do now is move to the other aspect of the current account, which is the net income balance, and just start to think a little bit more about the financial flows that are going on behind this. So the net income balance is the difference between how much Australians pay on their foreign liabilities, so interest payments on their foreign debt, and how much income we receive on our foreign assets, so things like dividend income that we get on foreign shares. So we have a net income deficit is the first point to note, and you can see that on the top right, on the top part of the graph there. And you can think about this because Australia's foreign liabilities are larger than our foreign assets, and so our payments are larger than the income we receive. And now the net income balance doesn't normally get as much attention as the trade balance. It's much more stable over time. But around the pandemic there, you can see there's some particularly significant moves. The net income balance narrowed fairly significantly in the kind of around the pandemic there. It moved up towards zero, which added to the current account surplus. But since then, it's widened out more recently to a historically large deficit, offsetting some of that trade surplus and weighing on the broader current account. So if we look at what some of the key drivers behind this and what they might be, if we could look at the bottom panel, you can see that the main developments here were driven by the equity line. And so some stories around this are that during the pandemic, Australian companies delayed dividend payments, which meant there was less money being paid out to foreigners. But since then, you can see it's swung back the other way as companies reinstated their dividends, as bigger profits, particularly related to the mining sector, have been paid out to foreigners alongside those higher commodity prices. And again, this has added to the net income deficit and offset some of that trade surplus. So that's where I want to wrap things up from the current account perspective. And what I want to do now is move to the financial account, where we'll see a number of the same stories playing out through that view as well. So just to recap and keep things fresh in our minds, the financial account records financial transactions between Australia and the rest of the world. And these are typically thought about as the net flow of capital from Australian investment abroad and foreign investment into Australia. So this graph here shows these net capital flows and reiterates the point that we imported capital and had a financial account surplus for much of our history. But as you move to the right of that graph, you can see the same large shift from around 2016, where we moved towards a world of net capital outflows and a financial account deficit. Again, the mirror to the current account surpluses. So looking at a breakdown of net capital flows, we can do this by investment type, and we can get a better idea of what's been driving this shift. So the main investment types that I want to focus on here are direct investment and portfolio investment. So direct investment is typically longer term in nature and occurs where investors own a greater than 10% share in businesses, while portfolio investment is more related to purchases of shares or bonds. And so adding direct investment here in the yellow bars, you can see the main story that I want to focus on is this recurring theme around the mining boom coming to an end and the associated decline in investment. And in the financial account, this is reflected in foreign direct investment flows declining, which you can see there. For a number of years prior to this, foreign direct investment represented a large share of Australia's capital inflows, and a good chunk of this flowed to the mining sector. But as the mining boom came to an end, investment in this sector declined and wasn't fully replaced by inflows to fund investment in other areas. And so again, the pandemic is another key point in this timeline. And another part of the story is around the onset of the pandemic, where uncertainty increased and risk sentiment deteriorated. And there was actually a big fall in foreign direct investment globally. Essentially, existing projects were cancelled, investors reassessed the outlook for investment, and this also flowed through to the Australian experience too. So a little bit of a build for you, and adding on portfolio investment now. You can see that this accounted for a large share of inflows, particularly before the financial crisis in 2008. And that's when Australian banks relied heavily on offshore markets for their funding. Following this, portfolio inflows were also supported by foreign purchases of Australian government debt. But the broad story that I want to focus on here, and notwithstanding the latest data point, is the decline in portfolio investment over recent years. And this largely reflects the increase in savings and the continued expansion of the superannuation sector. So there's been a big increase in super over a number of years. And as part of this, there's been a trend towards investing in equities as investors move out of lower return assets like cash and fixed income. On top of this, super funds have also noted an increased share of foreign equities as investors look to diversify their portfolios and increase returns, with foreign equity prices growing faster than those domestically. And so in the financial account, this has been reflected in greater portfolio outflows, which you can see in those blue bars there over the past few years. And overall, these two trends of the superannuation sector and the mining, coming off the mining boom, have been key contributors to the large shift that has occurred in the financial account. But another aspect that I just want to focus on quickly relates to the banking sector around the pandemic, and it just shows kind of different cuts of these data that you can look at as well. And so we can see a different cut of the data here. That same black line flows through, but this breaks things down by capital flows for banks, the public sector and private sector. And with this graph, I just really want to focus on the banking sector around the pandemic there. And so looking at the dark blue lines, you can see there were large capital outflows relating to banks in 2020. And so while banks had reduced their reliance on offshore markets after the financial crisis, they still borrowed from these markets to top up their funding. But you can see with that large outflow that this reversed sharply during the pandemic. One of the reasons for this is that banks didn't need to borrow from offshore during that market turmoil because they had access to low-cost funding domestically, including through the RBA's term funding facility. And as a result, banks' stock of offshore debt declined as it matured, and this resulted in a net capital outflow. But since then, you can see from the last two bars there, banks have returned to offshore markets as they look to diversify their funding sources, and these portfolio debt inflows have increased again. I think one final point to note, just looking at the graph and what stands out, it also adds a little bit of narrative and colour to the story around 2020, is the big capital inflow to the government in 2020, that pink line there. And this is related to foreign purchases of Australian government bonds during the pandemic period. And it reflects the large amount of debt issued by the government to fund its fiscal policy response during this period. So hopefully these breakdowns have provided a bit more colour and a bit more of a story around net capital outflows in the financial account deficit over recent years. And what I want to do now is cover how some of these developments have flowed through to the international investment position and link these financial flows that we've been talking about to that part of the accounts. So the international investment position can be thought about as the stock of debt and equity that we owe the rest of the world, less what the rest of the world owes us. And in Australia's case, we have a net liability position. You can think about that as each quarter that Australia has imported capital to fund its investment, this has accumulated in the background and added to what we owe foreigners. And this is added to our net foreign liability position. And we can also think about the effect of recent capital, the shift to recent outflows as well. And so one example to think about here is that these outflows build up our foreign assets and help to offset some of that net amount that we owe foreigners that's been built up in the past. And so this has helped contribute to a decline in our net foreign liability position. The other aspect of these accounts is that there are also some valuation effects around prices and exchange rates too. But looking at some data now, you can see on the graph here that the net liability position sat at around 50% since the early 1990s and peaked at around 60% in 2016. Since then, though, it's declined to around 35% of GDP as we've seen the effects of these net capital outflows as well as valuation effects taking place. This graph here shows a breakdown of the composition of our foreign liabilities and how they've changed over time, which again can be helpful for thinking about key drivers. I think one of the key trends for me, and one of the key drivers of the decline over the past 5 or so years, has been the increase in Australia's net foreign equity asset position. And that's actually shown as a decline in the yellow line there because we're looking at it in a net liability position framework. But to get our heads around that, Australians have owned more foreign equity than foreigners have owned of Australian equity. And much of this can be linked back to the expansion of the superannuation sector and larger increases in foreign equity prices. So again, super funds have continued to increase the size of their foreign equity portfolios. And because of this, Australia's net equity asset position has continued to increase. And this has contributed or dragged down the decline in our overall net foreign liability position. Another key trend that you can see from the graph is the shift from short-term to long-term debt. And this partly reflects an increase in foreign purchases of Australian government bonds, as well as a shift away from short-term debt by the banking sector after the financial crisis. And so thinking about valuation effects now as well, and if we think about that long-term debt line there, not only is this affected by financial flows, but also by movements in interest rates. And this affects the market value of debt that is recorded. And if we think about the recent rise in global interest rates, this actually reduces the market value of debt that Australians owe to foreign investors because of the inverse relationship between yields and bond prices. So the decline in the total net foreign liability position there reflects both net outflows over recent years as well as the effects of price changes. So just on a bit of a broader point, when we're thinking about the net foreign liability position, and I also understand that students are often asked about the possible consequences of current account deficits and foreign debt. I just wanted to quickly touch on why high levels of foreign debt are regarded as a vulnerability for an economy. And I think this is an important point. And historically, it's been high levels of foreign debt denominated in foreign currency that has typically got countries into trouble. And this comes back to those valuation effects. Exchange rate movements can have a big effect on the amount that needs to be repaid if the debt is denominated in a foreign currency. In particular, a sharp depreciation in the exchange rate will lead to a rapid increase in this debt when you translate it back into domestic currency terms. And so essentially, the country's ability to service the debt and repay it worsens. And it's these types of situations that generally lead to debates about whether the level of a country's foreign debt is sustainable or not. And these are the typical situations that have been related to the currency crisis in Latin America and the Asian financial crisis too. But taking the view from an Australian perspective, it's quite different here. And that view is that Australia's net foreign liability position is not generally considered a vulnerability because most of our foreign debt is actually denominated in Australian dollars And where it's not, it's hedged back into Australian dollars, which reduces this exchange rate risk. In addition, another point to note here is that the external funding that has taken place for Australia has been used for productive investment, which has supported employment and benefited the Australian economy more broadly over time. And so this is where I want to finish up on our tour of the external accounts today. And just in summary, what we've seen is one of the most significant shifts in Australia's balance of payments over recent years. In particular, the current account has shifted from deficits to a surplus, and equally, savings have increased to exceed investment. And the two key stories that have flowed through the presentation today were the increase in the trade surplus that's been reinforced by higher commodity prices, and two, a decline in investment following the end of the mining boom. And on the financial account side, this has been mirrored by a shift to net capital outflows and a financial account deficit. Here we saw those same stories reflected through a decline in inflows of foreign direct investment and outflows of portfolio investment into foreign equities as the superannuation sector expanded. And together this has flowed through to an increase in Australia's net foreign equity asset position and a decline in our net foreign debt position, both of which have contributed to the overall decline in Australia's net foreign liability position. So hopefully with that, I've been able to link together the different bits of Australia's balance of payments, highlight some of the key stories that have flowed through the accounts, and also provide some material that you can take back to the classroom today. So thank you.